you should not save money. I know this statement sounds harsh, but it's true. Saving money is not a good strategy when trying to build your wealth. In this video, I'm going to go over why this is and also what you can do instead to be smart with your money. The first thing to understand about this is opportunity cost. Opportunity cost is the loss of potential gain from other alternatives when one alternative is chosen. I know that may sound a bit complicated, but trust me, I'll explain. It basically means that when you make one choice, you're giving up another choice. An example of this would be going to a pet store and deciding between a cat and a dog to take home. If you bought the cat, then the opportunity cost of buying that cat would be the dog because you wouldn't be allowed to take that dog home. Or you could buy the dog and then the opportunity cost of buying that dog would be the cat. Okay, but how does this apply to saving money? When saving money, there is an opportunity cost. The stock market on average returns 7% year over year, and that's adjusted for inflation. That means for every dollar that you stick into the stock market, at the end of the year, you'll have an average of $1.07. If you stuck $100 in there, you would have $107. So that 7 cents or $7, depending on how much you put in, is the opportunity cost of not investing that money. Now 7 cents or $7 may not sound like a lot of money, but trust me, it adds up. If you have $10,000 sitting in your savings account, you're missing out on $700 per year. If you have $100,000 saved and just sitting in a savings account, you're missing out on $7,000 a year. And that $700 or $7,000 is not even the true opportunity cost, because of a concept called compound interest. Compound interest is the idea that a fixed percentage on your money over time will compound into exponential growth. I'm not going to go too deep into compound interest in this video, but a rough estimate is that your money today will be worth 22 times more in the future. So savings accounts don't do anything for you. When your money's in a savings account, it's just sitting there and not earning you any interest. So that money is not going to do anything. In fact, it's actually going to lose money to inflation. When saving for the long term, you should always invest your money. And if the stock market seems a bit too risky for you, there are tons of other investments out there. You could invest in real estate or even bonds. There is, however, one exception where saving money in a savings account is good. And that is when you're saving up for something in the near future. If you're saving up for something over the next month or the next couple months, then a savings account can actually be a very good option because you can avoid that fluctuation, and if a crash were to happen, you wouldn't be in a bad situation where you have to pull out. And I know what you're thinking. The stock market or real estate market sounds really risky. What if I lose all my money? In fact, you're actually taking a much bigger risk by not investing in one of those than you are actually investing in one of those. And that is because if you don't invest in one of those, you are guaranteed to lose money over time. Long term, you will lose a lot of money by just leaving your money in a savings account, and that is because of inflation. Inflation is on average 2% per year, although we're seeing higher inflation right now because of all the stimulus checks that have come out. So when you leave your money sitting in a savings account, it actually is losing money constantly. And that is not good. You really want to go into the stock market, and the stock market does not have to be risky. You can invest in the S&P 500 or the total stock market index fund, and those are very diversified assets. Those have tons and tons of stocks. The S&P 500 has 500 total stocks, and those are the top 500 US companies, and the total stock market index funds has 3,600 stocks in it that cover the entire range of the stock market. So it's not like if one company goes down, you're gonna lose all your money. Most of the time, you're gonna make money, and that's probably gonna be around 9 to 11% per year. Another good thing about investing your money is it is in a completely separate account than your checking account, so that means you will not be tempted to spend it. When your money is out of sight and out of mind, it becomes a lot more difficult to spend it. If you see a couple thousand in your checking account, you're like, oh, I can afford that new shirt or those new shoes. But if it's in the investing account, you don't want to sell one of your stocks to go buy some shoes. So overall, you're going to save more money and you're going to make a lot more money. When you invest, you can grow your wealth exponentially over time and set your kids and their kids up for complete financial success. The easiest way to do this is just put away a couple $100s each month into a Roth IRA or even just a normal brokerage account. As long as you're investing, you're doing something right. If you want to get started investing, I recommend Robinhood. They're a very easy platform to start on. It's very intuitive, user design is very clean. So if you want to check that out, I'll leave a link in my description where you can get an entire free stock by signing up. I really hope this video brought you some value. Thank you all so much for watching. If you enjoyed, subscribe, and also if you have any questions, make sure to comment them below. Thank you all. Have a great day.